recording. Sometimes I forget to do that. Okay, now let me share this page with you here. I think you'll like this page. There we go. So the SBDC, our services are offered to entrepreneurs that are looking to start a business and those that are already in business. And the types of services that we offer, as you're looking at this screen here, are offered at no charge because we are like a nonprofit funded by the Small Business Administration through the federal government, through the DCED PrEP program, which is through the state of Pennsylvania, as well as our local universities, in which there are 15 universities throughout the state of Pennsylvania that houses or hosts small business development centers. So we're forever grateful for them for showing their support, not only for our community in general, but for our small businesses in general as well. So that's how we can bring this service to you at no charge. And then also, what we learn from you is confidential. So we what we learn from you, we're not going to go out on the street and talk about and gossip about you. We've been around for over 40 years, actually over 45 years. So that to still be in existence that many years later, we hopefully are doing some things right. Okay. And I do truly believe the confidentiality is a huge thing that we better be doing right because we don't want to lose our trust with our clientele. So knowing that you can get business consulting services at no charge, one-on-one by phone, email, texting, video, and in person, knowing that you can get this service, in front of you are all the different services that we offer. Every business is in a life cycle stage, and that's the green that you see on your screen there. You're either in the introduction where you're starting your business, and of course you grow at some point, and then you mature or level off for a while. And then when you mature, you're going to go one of two directions after a while. You're either going to go down or you're going to go back up. In this example, we have you going down, at which time you better figure things out and renew or reinvent yourself so that you can go back up again, or otherwise you're going to keep going down, you're going to fail. So the bubbles there, you do not necessarily have to be in one of those green stages to utilize a bubble. Those bubbles can float around. That's perfectly fine. But as you're looking at this, if you see something here that is interesting to you, make a note of it. Reach out to your local SBDC consultant. If you're not currently hooked up with a local SBDC, then here is a list of SBDCs in the state of Pennsylvania. So find your location in Pennsylvania by county, and then look at the number, go over to the right, find the number, and find that SBDC that you would want to reach out to. So do a search on the internet for like Penn West University SBDC or Shippensburg University SBDC, and reach out to them to utilize their services to deal with any of these subjects that you see here. So there's maybe more that I could tell you about the SBDC, but I really want you to know what we offer so that you say, wow, this is amazing. I need to talk to them about this, this, and this. Okay. Okay. Let me go ahead and quit sharing this. And let me just do a little disclaimer as we are going to talk about tax tips and your questions and answers. This is a disclaimer that I'm just going to read to you so it sounds nice and boring. It says, any tax advice reflects our professional judgment based on our understanding of the facts provided to us and on current tax law. The SBDC is not responsible for misinformation as this service is offered at no charge to entrepreneurs and business owners. So what I'm saying here is that, when you ask a question, you're just giving me a little tidbit of information. And I'm trying to take that tidbit of information and brainstorm really quickly and come up with an answer. I would like to, if I don't know the answer, I tell you that. And other times I say, this is just enough. You probably ought to reach out to your accountant or reach out to your local SBDC consultant for more information. I do that a lot. But a lot of times I feel answer your question pretty good. This session deals with business taxes. Of course, I know that sometimes personal taxes come into it because, personal and business, they kind of go together tax wise. And then, but overall, other personal taxes, if you're not relating it to business, I like to try to steer clear of that. And then I also touch upon all kinds of other business related questions too, because, if you're trying to decide whether you want to be an S corporation or an LLC or a sole proprietorship, um, that may not in your mind deal with taxes so much, but it really does. There are, tax implications to any business related decision that you make. There really truly is. So I try to answer all of those questions that I can as well. So let's jump into the tax tip, which is dealing with VRBO, Airbnbs, and other types whenever you plan on renting out your home or a space that is just 100% Airbnb. So I kind of came up with 5 ideas that I want to share with you. And again, there's a lot more information, but I only can talk about it for a few more minutes. So first off is what they call the free money roll. If you own, and if you don't own an Airbnb or VRBO, that's okay. Just listen. We're going to get to the Q&A here very shortly, okay? And you might be able to help someone else out in the future just by knowing this little bit of information. The free money roll is number one. So if you rent your home for 14 days or less, then you do not have to report any income or any expenses. Now, you might be like, well, I want to write off expenses. And if you're going to show a loss, then okay. But if you don't have enough expenses to write off all of that profit that you rented out for 14 days or less, then you're going to have to pay taxes on the profit, right? Also, if you're going to put a rental on your tax return that you only rent for 14 days or less, then understand that your tax return fee with your accountant is probably going to go up some. So is it worth it? Okay. I'm saying it's probably not worth it. If you're going to rent out your home or a vacation cottage or something like that, if you're going to rent it out for 14 days or less, don't do anything with it. The IRS does not require you to claim a cent of it. It's like you having a yard sale. The IRS doesn't care about it because it's for such a short period of time. The catch, though, is if you rent that your home or your vacation cabin or something like that for 15 days, okay, then you have to claim all of the income since day one. So 14 days or less, ignore it. Hit the 15th day, though, you got to claim all of that income. And then you claim the expense that's associated with it. So if you're looking to rent out your cabin for like during a hunting season, or like I'm over here by Punxsutawney Phil, Groundhog's Day, which will be coming up here soon in February. Make sure you keep it under 2 weeks so that you can take advantage of the free money roll. Number two is the hotel tax. So when you are renting out your space through like Airbnb, they normally take care of the sales tax, the 6% state tax, and they normally withhold it and they pay it to the government, and you don't have to worry anything about it. But they don't always, and there can be some settings in there, but they don't always take care of your local tax. So I'm located right now in Jefferson County, Pennsylvania, and so there's a Jefferson County tax based on like these Airbnb spaces and such. And so you want to make sure that Airbnb, VRBO, and the others are paying that for you. And if they are not paying that for you, then you're responsible for it. And that's okay. Nothing wrong with that. I'm trying to think in Jefferson County, people actually do, I think, have to pay it themselves here. And so in that case there, just make sure that you're charging per night appropriately to cover that particular tax that you're going to have to send in. Otherwise, you're eating that tax and you're in a way losing a little bit of money because it's coming out of your own pocket. So that's number two, which is like the hotel tax trap. Number three is, are you a landlord or are you a business owner? If you're a landlord, you're going to file a Schedule E on your tax return, versus if you are a business owner, you're going to file a Schedule C on your tax return. You might be like, what's that matter, Corey? really matters because there's taxes involved. Schedule E, you're saving roughly 15%. You're not paying roughly 15% self employment tax. Whereas Schedule C, you are paying that tax. So you can Schedule E, not pay the self employment tax if you act like a um, if you just basically hand over the keys and let them in. Or I know when I say Airbnbs, they like give you a code to get into the door. So you get them in the door, and then they stay there. And when they leave, you clean up after them, and you're done. So you let them in, you clean up after them after they leave, after they're all gone, and then you let the next person come in. So that is a Schedule E because you're not really involved. That is called passive income. You're just kind of doing very little. Versus a Schedule C is active. You're being active. So it's active or non-passive income. That means you're offering more services, such as you're cooking breakfast for them, like a B&B, right? Or you're cleaning while they're there. Okay, like they leave and go out on a day trip, and you clean their place. Okay, um, and also maybe you do things like offering tours, okay, like planning tours for them, and maybe even taking them on tours. You're being more active with them, therefore that's going to be non-passive income. You're going to have to file Schedule C because it is literally a business, not just landlord rental. And you're going to be responsible for paying 15% self-employment tax on any profits that you show. So you have to decide what way you're going to operate your Airbnb, VRBOs, and so forth. Then, so number four, let's talk about deductions. Okay, there's a non-cash deduction called depreciation. That's where you take the value of that building, that house that you're renting out, or that cabin that you're renting out. And instead of like cash actually going out every month, it's a non-cash deduction. You take the cost of the home and you spread it out over a number of years, and like 27 and a half years according to the IRS, and you take a deduction each of those years. Although no money's actually going out, you are getting an expense on your tax return so that maybe you get a bigger refund. Okay. But then also you have expenses like repairs and maintenance. So if you break a window and you got to repair that window, it's a repair. You write it off right now. Although, if when you move over to the improvement side, that's something bigger. So, if you add a new deck to your home, to your building, then that's something that's going to have to be spread out over a number of years. Take a deduction each year. Again, that's like depreciation, is what we're talking about. You're spreading that cost out over a number of years. So, ultimately, my suggestion with the receipts, because if you're not tax minded, bookkeeping minded, then the best thing to do is keep your receipts, write on them what the receipt was for if it's not clear, and then you hand that over to your accountant. If you're doing bookkeeping like QuickBooks, then you're actually able to attach your receipts right there so that your accountant, when they look into your tax return or into your bookkeeping in QuickBooks, they can see those receipts. And also, when you're recording things within QuickBooks, there's always a memo area in there or a notes box in there where you can add more information to help your accountant determine what they need to do with it. And then if you're not really not sure, you can create an expense within your QuickBooks called Ask Your Accountant. And then when your accountant reviews your tax return and they see that expense that says ask your accountant and there's dollar amounts there, they can click on it. They can dive deeper into those expenses in there and ask you questions if need be and so forth, and ultimately move whatever's in that ask your accountant into the appropriate locations as necessary. Fifth and lastly is don't live in your rental is one option. Okay. If you live in your rental, You have to be careful that you do not live there for more than 14 days. If you live there for more than 14 days or more than 10% of the days it is rented, then the IRS is going to call it your residence. Okay, so you if you have a cabin out there, okay, as long as you're not living there for more than 14 days out of the year, then you can write that all off completely, whether rented out or not. But if you are staying there on the weekends and it adds up to more than 14 days in a year, then you can only deduct a portion of your expenses. So instead of 100% of expenses being written off, it'll be a lower percentage of your expenses. Not a terrible thing, but I'm just kind of saying, hey, there's these little rules out here that we have to follow. And your accountant tries to ask you the questions, tries to gather that kind of information so that they can do your tax return correctly. So, quick summary here. Um, uh, Number one was the free money roll, less 14 days or less. Don't have to claim it on your tax return. Number two is the taxes, like your Pennsylvania state sales tax and your hotel tax. Make sure you pay attention to those. Number three, are you a landlord or are you a business owner? Schedule E or Schedule C. And taxes related to that is your self employment tax of about 15%. It's 15.3. Number four is your depreciation versus writing off expenses immediately, like repairs. And then number five is, maybe not don't live in your rental if you want 100% deduction. Otherwise, you only get a percentage deduction. So I hope that you found that beneficial. I think I did that pretty quickly there. Tax season is coming, so I'm hoping that you all have some questions for me today. So I'm going to open up my chat and I am going to open up the Q&A so that you can put your questions right in there. I will also give people the opportunity to unmute themselves. Whoops, I didn't want to do that. Let me see something here. Allow attendees. So there is a button on your, I'm going to try something different this time. There is a button on your um, Zoom that says raise hand, and it has like a handprint like this, right? It says raise hand. If you have a question that you want to unmute yourself and you want to speak live, then feel free to raise your hand and I will call upon you. But of course, you can use the chat and the Q&A option to type your question in there, and I will look at it as well. So let me see here. I have a question in here right now from Christian saying, do you have any contact on the recent changes to the Philadelphia BIRT return rules? I really don't. I have zero idea on that. I'm from more of the Western Pennsylvania. I'm out in rural Pennsylvania, so I'm 2 hours to the closest city like Pittsburgh. Therefore, I do not have a great experience with the Philadelphia taxes. So reach out to your local SBDC consultant and see if they're able to answer those questions for you. If not, then you probably will have to talk to your accountant about that. Sorry, man, you hit me up with a question right off the bat that I could not answer. Okay, so I see there are quite a few people in here. I am so glad that you all came. I hope some of you have some other questions here that you can ask me. Otherwise, I start rambling about taxes, and that's not necessarily a bad thing either. I don't see any hands in the air yet. Remember, you click on that button on your Zoom that says raise hand and ask your question. Okay, so I have another question here. Great. So you're organizing a single day film screening micro festival event to take place next year. You're considering organizing an LLC for it, but because the event will be so small and you're not sure Whether you'll repeat it, you decided to keep it, just grassroots, basic. You plan to charge a small fee to filmmakers, submission fee to filmmakers submitting their work. Would an event like this qualify as under the yard sale rules you mentioned, or are there significant risks um, in not reporting this as income, particularly if submission fees are collected online? So that 14-day rule is very specific to this type of rental type of business. Uh, it really, to my knowledge, has nothing to do with any other type of business, which you're this different type of business, right? So I think I just throw away the 14-day rule in this idea here. And outside of specific rules like that, then the general rule is if you make a dollar, claim a dollar. But also, even if you don't make a dollar and you have expenses, they say you're supposed to claim all of your expenses. Now, with that said, me saying that, I want to be careful because um, I've seen, like, say, hobby farmers that say, yeah, I have a farm, therefore it's a business. And they show loss after loss, year after year after year after year, never showing a profit. And then I have a discussion with them and say, you better be careful showing loss year after year in this particular type of industry, which is being a farmer. They may come back and declare it a hobby loss. And if so, you're going to be paying back money to the government that you got benefits from those losses. Same thing with Avon and eBay and 31. You women know what 31 is, right? Different things like that. We got to be careful of the hobby rules if you're going to show loss year after year after year. Now, if there's a bar and restaurant out there and they're showing a loss, they actually rent a location and so forth, and they show a loss year after year. The IRS isn't so much closely watching that, although they, in a way, they are at another point in that because they know it's a cash-based business. They're professionals at audits. The government's professionals at that, right? And so they have their rule books that they follow, and they can come up with estimates of whether you're cheating the system or not. So back to your question, I had to talk about hobby and losses since I brought that up, and you might encounter this too if you do this year after year. The idea of being in business and putting stuff on your tax return is they want you to pay taxes to them. They want you to make money. If you're not making money, then why are you doing it? You're losing money. Okay, so then let's see here if I can point out anything else. Considering organizing as an LLC for it. I do think that you might have some liability issues involved where you could get sued and so forth. It sounds like other people would be involved and people will be coming to a premises, a location. I don't know if you're showing movies. I'm not sure if there's going to be, any music. Not sure if there's going to be any, alcohol or even BYOB kind of thing. But ultimately, when people are involved, you're best to have liability insurance because people will sue if they get hurt in any way, shape, or form. Okay. So if you don't form an LLC and you go with just a sole proprietorship, make sure you still get liability insurance. An LLC, what it's going to protect you from is if the LLC gets sued, then as long as you're operating according to the rules of the LLC, then your personal life, anything that you own personally, should be protected if the LLC gets sued. Whereas as a sole proprietorship, you are the sole proprietorship, so that if you get sued, you can lose everything you personally own. Is that a risk that you're willing to take? Insurance should cover you. And I'm not an insurance professional, but I always think in my mind that if I'm doing something illegal, the insurance probably won't cover it. I don't know for sure, but I would think they wouldn't cover it because you're doing something illegal according to the government, the law. If you're doing something misappropriate outside of and when you get insurance, they have like this full book of stuff you're supposed to read, nobody reads. But if you're doing something outside of that realm, okay, and then someone gets hurt or something, you may not be covered by your insurance. So that's why an LLC would come into play, is if your insurance doesn't cover for some reason, then you still have one extra level of protection, and that is the LLC. Let's see here. I think that was everything. Seemed like the LLC was your question. So that's a good question. If you have other questions, go ahead and ask it though, because nobody else is asking questions yet. So while I'm still waiting for questions, I'm not sure if you heard about the what's that big beautiful bill that our president created or something. And so there's a lot of different changes there. Some of it affects personal, some of it affects businesses. Of course, you might hear in the news, which I don't watch, but maybe it benefits the rich or the poor or somebody else. I don't know. I don't care. I more or less look at like how does these rules affect our everyday middle income individual and our everyday small businesses. So there is one for the vehicles. We talked about depreciation, like with the rentals and that. But let's say you have an auto car garage and you have a company vehicle that's owned by the business, 100% written off by the business. Um, they just brought back the bonus depreciation of 100% depreciation. Now, it doesn't have to be just on a vehicle, it could be on equipment as well, furniture and fixtures. There's some exceptions to it though. Like I don't think the building fits into that, and there's other assets that won't fit into it, but our most popular ones like equipment and vehicles do fit into it. I think it's at was that was Jan the rule went into effect like backdated. I believe it was January 20th of this year. If you purchased anything from like January 20th forward till now to the end of the year, it's 100% able to be written off. If you purchased it in the first few days of January, like up to January 19th, it didn't go into effect during those days. And there's reasons for that, but whatever. And so you don't get the 100% write off. Now, that 100% write off is, as of right now, considered permanent. So if you don't take advantage of it this year, you can take advantage of that 100% bonus depreciation next year. Um, um, and I say as long as that law, is still around, then it's permanent. Because, of course, when Trump leaves office and someone else takes office, I think they can change all that stuff. So it could change someday. Now, you don't have to write off those assets 100%, but that is an option available to you. So that's a great benefit for businesses. So whether you like our president or not, whether it would have been another president, giving this benefit, I'm for it. I like this benefit. I don't care about who put it into place, but I do like that benefit. Okay, so I see a question over here. Will the LLC require a series of business taxes, or might they all be written off by the carried losses of the festival? Hmm. So I'm not sure I really understand that, but let me try to follow what I think you're saying here. Is does the LLC require a series of business taxes? I mean, if you're an LLC sole proprietorship, meaning an LLC owned by one person, or even an LLC partnership, which is owned by more than one person, then it has its tax form that it goes on. I mentioned that Schedule C earlier, and so if you're a sole proprietorship LLC, then your income and your expenses go on to that Schedule C. So it's just list your income, list your expenses, whatever's left over at the bottom, either a profit and you pay taxes, or a loss and you don't pay taxes. Um, and even if you're an LLC S corporation, then it has its own tax return, but it doesn't actually pay taxes because it all flows onto your personal return. So same thing, income, expenses. Now, other types of taxes that could be involved. I'm not really sure about this type of business. That you'd be opening up, but for all of you, you have sales tax, you have income tax. That's what we're talking about on your tax return, income tax. You possibly have use tax that you might have to pay. You, if you have employees, you're going to have employer taxes or payroll taxes. Let's label it that way, payroll taxes. And then, depending on where you're located at, in which, I think you're in the Philadelphia area. So depending on where you're located at, there could be like an entertainment tax or an entertainment license that you have to get, or an entertainment permit Okay, just think about entertainment. So you have to pay a fee to your local township, borough, city, whatever it is, and for that event that you are hosting. Okay, so you won't be like a year long license. It'll just be in your case like a per event fee that you'll have to pay. So you can think of that as taxes if you want. Um, Again, reach out to like your local municipal office and explain to them what you're thinking of doing and ask them if there's any permits, licenses, or taxes specific to the locality, the municipality that you'd have to pay. Okay, I have another question here. Um, as for paying into estimated taxes by the end of the year, what is the guideline on percentage of federal taxes that should be paid in as estimated quarterly tax? When is the cutoff for 2025? And is there also estimated taxes for state and local? Great question. So, um, guideline on the percentage of federal taxes. Now, depending on the type of business that you are, are you a sole proprietorship, partnership, LLC, S corporation? Sometimes those can play a key in it. But ultimately, if you look at your personal income tax return and you look at last year's and you say, what tax bracket was I in? And if you have someone do your taxes, or maybe if you do it yourself, maybe it prints something off that tells you what your effective tax rate is, then whatever rate you're looking at, either your tax bracket or your effective tax rate, base your estimated taxes on that percentage. So let's say that you're in the 12% tax bracket. Then whatever profit you show, that's income minus expenses equals profit. If you're showing a profit of $10,000 at the end of the year, then take that 10,000 times 12%, which is what, 0.12, right? 10,000 times 0.12, and that should equal $1,200. And so if your profit for the year is $10,000, then you owe $1,200 on that. So you take $1,200, divide that by 4 quarters, and that's what you're sending into the federal government. Now, your accountant, I would assume, should and could be helping you out with this, especially after they do your tax return and they see where you stand at. They should be giving you vouchers to send into the federal. And by the way, you mentioned state and local as well. Yeah, absolutely. There are estimated taxes for state and local. State is based on 3.07% of your profit left over. Local, depending on your locality, but general local is 1% across the state. But then some municipalities, such as Philadelphia and Allegheny County, I should say higher, have their own sales tax as well. So you not only have the general 1% across the state, but sometimes it's 3, 4, something percent in these other cities. And so yeah, you take a $10,000 profit left over at the end of the year, times 0.0307. That'll tell you the state. And then also 10,000 times 0.01 will tell you the local or whatever that tax rate is. And then there's voucher forms specific for the federal, state, and local government. I'm trying to find an account. Okay. So LLC, and if you're an LLC, sole proprietorship, everything I've said so far, right on. Okay. And so those vouchers, okay, if you're used to making vouchers, then you put it here, you're looking for another accountant. So if you're used to making vouchers, then talk to your accountant, tell them about it, and they can kind of like help with consistency. But if you've never paid quarterly vouchers, then your accountant will be having that conversation with you, looking at your profit and determining what your quarterly should be. So that's a really good question. Let me go back to this and see if I hit up everything. As for payment as a guideline, and should be paid an estimated quarterly tax. Okay, so another part of that guideline at the federal tax level is your self-employment taxes, and which you as an LLC would be paying. So that is 15.3%. You do to get a deduction for half of that on your tax return, but then you turn around and literally pay the entire 15.3% on the profit, not your total sales, just that profit. So that will be added on to that 12%. So I think we normally tell people for federal to try to set aside a total of, say, 30 to 33% of your profit. So $10,000 profit. So $3,300 you probably should set aside for federal taxes. That'll take care of your federal income tax of 12% and then the 15.3% roughly. When is the cutoff for 2025? So your fourth quarter is due on January 15th. It's always due on the 15th. But again, I can't say that I remember it exactly, but it doesn't follow a quarter like we always say. Okay, so let's start at the beginning of the year. January, February, March. The first quarter is due April 15th. But then the next payment is due June 15th, I believe. So it really doesn't follow a full quarter, right? So if you paid for January, February, March, and you paid for it in April, okay, and then the next one's June. So then you have January, February, March, April, May, and then you pay June 15th. So you're really only paying for 2 months there because it's due June 15th. So April, May, and then the next one, let me see, April, May. I think it's due October, April, May, June, July, August, September. So then I think the next one's October 15th. So you're actually paying for 4 months. Okay. And then the last one does cover October, November, December. So it does follow a quarter. Okay. And it's due January 15th. Okay. So I got all that. Okay, I'm going to move on to the next one. I don't see any hands in the air, so I will keep going with the questions here. Okay, that's about otter, so I don't need to answer those questions. That's not a question. Okay, this one here says, I incorporated an S corporation on November of 2024. I'm a sole owner. I have not paid myself a salary. S corp distribution owner, $500 in July 2025. How is owner disbursement taxed? So be very careful with that because as an S corporation, you're not supposed to take out any distributions unless you are taking a reasonable paycheck from your company. So if you are able to take money out of the business, even as a distribution, then you should be getting a paycheck, is what the government would say. So your accountant may list it as just a disbursement, but they may try to figure out a different way to list it. And again, I got this much information I'm going by, but I might be trying to brainstorm with you and say, oh, was it a reimbursement for certain expenses that we could put in as a reimbursement instead of a disbursement? But ultimately, if it comes down to that it's just truly taking money for yourself, then it would the accountant very well may want to set it up as a paycheck where you took a $500 paycheck from your business for the year. And then you owe payroll taxes such as employer taxes, Social Security, Medicare, federal income tax, state income tax, local income tax, all that stuff. I would steer clear of that. So if you don't plan on giving yourself a real paycheck for a while and you don't need to take disbursements out, then don't do the disbursements because you're supposed to do it as a paycheck. I hope that answers your question there. Ultimately, how's the owner disbursement taxed? I mean, distribution isn't taxed, okay? But it's really not allowed unless you're taking a paycheck. With that said, hey, I mean, people make these mistakes, when they start their businesses, things like that. That's where accountants come into play and SBDC consultants come into play, is to try to work with you and fix these issues. And your local SBDC consultant might have an accountant on hand or that they can refer out to, like an SBDC accounting experienced person like myself. And I do have SBDCs across the state of Pennsylvania that that end up reaching out to me and say, hey, I have this client that has this type of tax question. Can you spend 30 minutes with them and chat and help them through this? And I'm more than glad to. And they know that. Okay. So everyone's using Otter. That's interesting. Okay. Next up here, does the S Corp pay federal state profit? Can profit be used for next year's expenses? Okay, that's a cool question. So the S corporation, if it has a profit, right? If it shows a profit at the end of the year after subtracting away its expenses, then the S corp itself does not pay any taxes at all, like income taxes. Doesn't pay federal, state, or local income taxes. What happens is that S corporation creates a form called a K1 form, and that K1 is distributed to the owners of the business. Could be one owner, could be multiple, but it's distributed to the owners of the business. And then that K1 goes on to your personal income tax return. And so the profits of that S corporation, you will pay your, like I used 12% earlier, your 12% tax bracket. You'll pay 12% tax on it. You'll pay 3.07% at the state level, and you'll pay your 1% or more local income tax on it as well. You do not, on the profit of the S corporation, you do not pay any self-employment taxes on it. So that is a tax advantage of being an S corporation. Your next question is, can the profit be used for next year's expenses? No. The expenses are connected to the income for that year. Most of us operate in a calendar year, January to December. Some businesses may operate on a fiscal year, which is just pick a month and it's a 12-month time frame. Most places don't do that though. Most small businesses are 12 months, January to December. So no, you don't carry those expenses forward. There can be some exceptions with losses being carried forward, but your profits definitely not. And can specific expenses be then moved forward? No. Okay, I'm going to come back to the chat, but I'm going to go over here to the Q&A section because there's a Q&A that's been in here a little bit. Someone's saying, it's my first year in business as a single member LLC, so no past tax records based on like what I said. Should I estimate my tax based on income bracket or profit bracket? Where can I get the guidelines on tax brackets by bracket? Okay. First year in business as a single member LLC. So if you just opened in 2025, so there's a lot that goes into this. I would ask, do you normally get a refund on your tax return, or do you not normally get a refund on your personal tax return? And if you do normally get a refund, how big is that refund? If it's a pretty big refund, then that might be enough to cushion you so that you don't have to send in quarterly estimated payments this first year, but definitely we might look at it for the second year. But I have to be careful what I say, because if you're in the consulting industry, or an industry that has very little in expenses, but you make a lot of money, then you're going to show a lot of profit because you have so few expenses. So your question, should I estimate my tax based on income bracket or profit bracket? I'm not really sure what profit bracket is. That one just doesn't relate to me. But income bracket is again, or maybe I understand. Okay. If I understand income versus your profit, okay, I talked about income is your sales, okay, minus your expenses is your profit down here. It's always on your profit. It's never on your income up here. Okay, it's always on your profit. And so based on that profit left over at the end of the year would be like, are you in the 12% tax bracket? Are you in the 15% tax bracket? Again, looking at your tax return and seeing if there is something, it's not really on the tax return itself, but it's normally like your accountant gives you extra pages that is like for your information type of pages. And if you look for something that tells you, what your income tax rate was, or your tax or your effective tax rate was. But if you are looking like literally for a guideline on tax rates by bracket, then just do a search on Google for 2025 IRS tax brackets. 2025 IRS tax brackets. And you might find something like the IRS's website, but you also might find articles from like news companies and that out there. Click on it, skim down through, and they'll outline it. It'll be based on whether you're single, married, head of household, married, filing separate. It'll be based on that, and then it'll give you tax brackets based on that. You could also use AI, such as Gemini or ChatGPT, and you could ask it, what are the 2025 IRS tax brackets? And it'll pull that information for you very quickly, okay? And it probably will be good. But understand AI can be wrong as well. Okay, next question. So this person's saying, I've never paid estimated for 2025. Also haven't paid use tax. I do pay sales tax monthly. Clearly, I need help. So thank you. Okay. So never paid estimated for 2025. So we've been talking about that a lot. So that's good. Use tax. Let me cover that really quickly for you. You don't always owe use tax, but every business may have to pay use tax at some point. So if you buy something from a supplier, from a vendor, okay, you buy something from them, and then you turn around and resell it, you don't owe use tax, okay? Reselling it is a whole different ballgame. That's for somebody that has like a store where they sell stuff at, right? You buy it from one place and you resell it to somebody else. But for all of you, every one of you, if you buy something normally from out of state, is how this works. If you buy something from out of state on the internet and they do not charge you sales tax, but the thing that you're buying, if you were to buy it in Pennsylvania, there would be sales tax on it, but they're not charging you sales tax because they're from out of state. When you bring it into Pennsylvania, when it's shipped to you and it comes to you, whether you even open the box or not yet, you're considered using it because it's now in your ownership. And so since it is a sales taxable thing, something that you're going to use in your business, you're not reselling, you're going to use it in your business. Take like a computer. I'm on a laptop right now. A laptop is something that if I buy in Pennsylvania, I would have to pay sales tax. So if I buy it from a small business outside of Pennsylvania, they probably will not charge me sales tax. When it comes here, I owe 6% use tax to the state of Pennsylvania. And if there was a shipping cost to get it shipped here, then I owe 6% use tax, not just on the computer, but also on the shipping. And I owe that to the state of Pennsylvania. And it goes on a form called a PA-1, PA-1. So you can jump on the internet, jump on AI and ask AI, what is the PA form 1? What I call PA form 1. Yeah, what is the PA form 1? And I would write it out as like, what is the PA-1? And read about it on Gemini or on ChatGPT. And you would owe that to the state of Pennsylvania then. So all of us, if we buy something where we're not charged sales tax, we owe use tax then. Now, if you're buying from big companies like Amazon, okay, or just a big store like Staples, okay, then they will charge you use tax. They have to. With that all said, you probably want to think about buying locally. That is the idea of small businesses, is try to buy some stuff locally as well, especially if we want our local community to buy from us, right? Okay, moving on. You do pay sales tax monthly, good. And I do think in your sales tax, when you're filing your sales tax, there's a place to pay your use tax also. So instead of completing an actual PA-1, you can do it when you're paying your sales tax. But if you're someone that doesn't have to pay sales tax, then you use the PA-1. Clearly, I need help. I hope I'm helping you. Okay, next question. I'm going over to the Q&A. I started a single member LLC in March 2025 and have no tax records. Ooh, well, I hope you mean past tax records. I hope you have tax records now. I haven't paid any estimates at all. Okay. Someone said I won't get any penalties for late estimates because it is my first year of business. I plan to calculate and pay my estimates in December 2025. Should I expect penalties or not? So the way, and that's partially, yeah, right, is that with the IRS, if you owe less than $2,500 to them on your 1040 tax return, then they shouldn't penalize you. At the state level, it's much smaller. It's $250, but of course, their tax rate's a lot smaller too. So, if you owe less than $250, they shouldn't hit you with any interest or penalties. And the local, I've never seen the local. Now, I'm not saying that they don't penalize you for owing too much at the end of the year, but I've never seen one, and I've seen people owe hundreds of dollars. Um, um, so if you're under the $2,500, I believe you will be okay. But once the government sees that you do owe money, and then the next year you owe money again, even if it's less than $2,500, there's times where yes, you do get hit with penalty and interest. So absolutely, if you're going to owe money on your 1040 tax return, then you want to start making quarterly payments. So you're on the right track there. Let's see here. Plan to calculate pay estimates in December. Should I expect? Okay, I answered that. Good. Um, Let me go over here. Good questions, everybody. Someone in the Q&A saying these sessions are so helpful. Thank you all for giving your time. Wonderful. I'm so glad that you're happy with this. Let me come over here. Okay, so what are the penalties? What are the penalties associated with paying the totality of your estimated income taxes halfway through the fiscal year? So you didn't pay them quarterly, rather you skipped a quarter and you're just paying it in the middle of the year on that second one. And then maybe you didn't make a third quarter payment, and so you wait till the fourth quarter. There can be penalty and interest for that, especially if you are a business that the government says you are required to make estimated quarterly payments. Now, you're required to do it, but you're not required. But if you don't do it, you get penalized, right? So in a way, you are required to do it. They don't want you to send in only 2 payments a year. Not if you are a business that has kind of consistent income all year long, then they expect 4 quarters. If you are a business who goes up and down with your sales, and so maybe one quarter you have basically like no profit, okay? Income or sales minus expenses equal profit. So you have like one quarter where there's no profit at all, zero or negative. You might be like, okay, I don't need to send in a quarterly voucher. My suggestion would be you send in a quarterly voucher as a zero, so that you show that you are consistently and being responsible in doing it. And then the second quarter, you have a profit, so you pay money. Third quarter, you have a profit, so you pay money. Fourth quarter, maybe you have no income again. I'm thinking like maybe a building contractor or something. Wintertime, you don't maybe do as much work or something, and so you have no income in that fourth quarter. And so again, I wouldn't ignore sending that in. I would send it in with a zero, so that you show that consistency, because yes, they can penalize you for that. Good question. Um, if I need a paycheck, can I pay myself once a year at end of year? Absolutely. There is no rules on how many and how often you should get a paycheck. So you can pay yourself once a year, twice a year, 12 times a year, 26 times a year, 52 times a year. I'm just kind of looking at weekly, bi-weekly, monthly, semi-annually, annually, whatever you want to do. Doesn't matter to the government, as long as you're paying yourself. So I'm not sure if you're the same person from earlier or not. I do apologize. Lots of people's names going on right now. But yeah, like if we're talking about like that $500, we can set that up. Not me, but your accountant can set that up as a one paycheck a year. But you gotta do it and pay yourself by the end of this year. You can't pay yourself in January for last year. If you pay yourself in January of 2026, then that goes on 2026's W-2. It's all related to 2026. You have to receive that check by 2025. Now, that $500, if it was paid months ago, okay, and if y'all have been following along, you remember this $500. That $500, seeing that it was probably paid months ago, then yeah, that's okay, because it's within the 2025 tax bracket area. The taxes on that, your accountant would probably want to try to put that $500 in the fourth quarter, because the taxes on that is due the due by the end of the month of the following month. So it would be due January 31st is when the taxes on that would be due. Your accountant may not want to show that you paid that $500 in the third quarter because that would have been due July, August, September would have been due October 31st. And now since you're not paying it till now, you're paying it late. And so you're going to get penalty and interest there. Just putting that out there. Okay, somebody else. Is there a recording available after this? Yes, I am recording this. And so there's another person at the SBDC that once the recording is officially like downloaded from Zoom, then at some point this other person will upload it to our YouTube page, and there is a playlist that where all of these tax talks go into. So I'm just trying to look it up here really quick for you. So 1 second. Okay, so I'm going to give you all right now the link to our YouTube. And if you go to that, I don't think there's a whole lot on there. I'm not sure. I myself really don't go there. But you click on there and then look for the word playlist, click on playlist, and then you should see several playlists there. And one of them will be Tax Talk with Corry, of which then you can watch all of our past ones. Okay. Hey, let me continue on here. How would you recommend quickly auditing for use tax on 2025? Oh, yeah, that's a good question. It depends on how you do your record keeping, of course, but look through your expenses, such as, thought I had that sentence. Look through your expenses and see if there's expenses like supplies, because that'd be like paper and envelopes, or cleaning supplies. Look at operating supplies, office supplies, or office expense, operating expense, however you label it. Look down through your list of expenses, looking for anything like physical in nature that you bought, and look at them, and then find those receipts and make sure that you paid tax on those receipts. Now, if I had a more time one-on-one, with you, or you talk to your SBDC business consultant, we could dive a little deeper into that, because I mean, utilities you don't pay the use tax on. Services you don't really pay the use tax on. It's more physical items. So then you ask yourself, where did I buy these physical items from? Did I buy them on the internet? And if so, did I buy them from a small business? Then yeah, I probably wasn't charged sales tax. But if you bought it from a big business of any sort, okay, whether it be any sort, a big business of any sort, they probably charged you sales tax. Okay, I'm going to continue on here. I'm a little bit over, so feel free to leave whenever you want. You may get a survey. I can't recall. You might get a survey. If you do, please fill that survey out so that we know what you like and what you dislike about this type of format. Q&A format versus a full-fledged webinar. We're trying to do something different. We've been doing it like for 2 or 3 years now. So make sure you do the evaluation if you get it. If you need to leave, feel free to leave. I'm continuing on for a couple more minutes. For the S Corp K1 form, does the owner pay taxes on the profits even if they do not receive money? Yes, absolutely. Next one. These talks also help sole proprietors understand we are not alone in navigating terrible taxes. Absolutely. Some of us are artists or just doing what we are passionate about. Unfortunately, we have to wear all the hats, and some of the hats we don't enjoy. That is so true. Absolutely. So thank you for sharing that. That is absolutely correct. And that's where I come into play, right? Because I love taxes, so I can help you out. I have a Q&A here. Hi, Corey. What if you are a landlord collecting rent from a tenant on a property that is owned by your LLC? How are taxes to work in this case? Okay, you got to read. So sometimes I have to read these a couple times, right? First time it kind of sinks in a little bit. Next time sinks in more. Okay, what if you're a landlord collecting rent from a tenant on a property that is owned by your LLC? So your LLC is the one that is renting it out, right? So your LLC has to show the rental income. Now, if the same LLC is a landlord, which is what you're explaining here. But also, if your LLC is another type of business, okay, then you're probably looking at having like two kinds of tax returns done because you have rental income, but then you also have another type of income over here. It might be a service income, it might be a manufacturing type of business, it might be a retail type of business, and so there's different taxes involved. Theoretically, from what I'm talking about here, there's different taxes involved here versus the rental income. So two different tax forms. So ultimately to save you money. So when you're doing your bookkeeping, make sure you keep that separated so that your accountant can see it, okay, and can determine what to do appropriately with your tax return to save you taxes possibly with the IRS. So that rental income again would be classified as passive income, which is Schedule E income. Whereas your other type of business, if there's two things going on at one time, this other business is probably going on to like a Schedule C. Even if you're an LLC, one owner, Schedule C. If you're an LLC partnership, it's still the same kind of division, but it goes on to a partnership tax return. Or if you're an S corp, which you could be an LLC tax like an S corp. It goes on to the S corp tax return, but it still gets split up so that it's taxed differently. Great job. So I have a Q&A here that says, do SBDC consultants provide services for free? All of our SBDC consulting services are offered at no charge across the state of Pennsylvania and across the country. There are SBDCs in every state of our country as well as our U.S. territories. So our services are offered at free. There are some trainings that we offer, like webinars or seminars that we can charge for, but that's because we just do that kind of like because we want to. It's not part of like what the SBDC truly offers. The SBDC offers business consulting. And so if we offer training, that's just something extra we're doing. So as an example, in January, I will be teaching a webinar called for QuickBooks. Okay. There's a QuickBooks level 1 and a QuickBooks level 2. It's kind of an expensive class. But it's a very valuable class. So when you look at the price, if you divide it out by the number of sessions and hours, it's really cheap. It's actually, we're underpriced. Okay. So my QuickBooks level 1 is 4 sessions, 2 hours each. And then my QuickBooks level 2 is 4 more sessions, 2 hours each. And we cover QuickBooks Online from beginning to end, very deep. Okay. There is a fee for that because that's not part of really what the SBDC does, but we do it because we want to help you. We want to educate you, but there are expenses involved. And so that one has a fee. There's some others that might have fees to them as well. But you don't ever have to attend them. We won't force it down your throat that you have to attend any of these classes. Okay. They're your choice whether you want to attend or not. That's why we can charge for it. Our business consulting services, I always offered at no charge. We're funded by the federal, state, and local government so that we can offer this fee to you at no charge. Or I shouldn't say local, federal and state government, as well as our universities that we're located in. Okay. But I don't do taxes, and SBDC consultants don't do your taxes. We don't represent you legally. We don't sell insurance, and we don't sell any other type of service either. Okay. It's a service offered at no charge. Okay, everybody. Thank you very much. There are no more. One more came in real quick. Where can we see a list of webinars and classes available by the SBDC? Okay, that is great. Let me bring that up for you real quick here. I have this here in another click. Okay, so I'm going to copy this link in here for you that you can click on. And then when you go to that link, there are ways that you can filter, if you want to say. You can filter it by date. I'm looking at it right now. You can filter it by date. You can filter it by topic. Okay, there's a whole list of topics. You can filter it whether it's live, on demand, and so forth. So you can do that one. And then there's one where you can filter it by center, like by each SBDC location. I wouldn't worry about that one because you can attend a webinar anywhere, right? So feel free to look at all of them and see what's available. And most of them are free. Really, most of them are free. So take advantage of that training. Okay, everyone. Thank you very much. Have a great day. We will be back here next month, so please keep an eye out for our next month's tax talk with Corry. I can tell you that I think the next one, let me see here. Next one will be in January. Ooh, January 2026, right? January 2026. And we normally try to follow a consistent pattern. So today is a Wednesday, and I have it in my calendar as Wednesday, January 21st. Wednesday, January 21st, same time, 11 a.m. I do believe that a new link comes out for 2026. So the link, if you've been coming back every month with this same link, it won't work anymore. Come January, you'll have to get a new link. So watch for our find it online. It might already be on that website that I gave you. Otherwise, watch your email since we send out emails. Take care, everyone. I hope you learned something. Have a great holiday. Bye.